On May 6, 2010, the Dow, a major U.S. stock index that tracks big companies, lost 9% in 36 minutes. Your screen would have looked broken. Prices vanished, orders filled at levels that made no sense. Then, almost as fast, the market snapped back. That day taught a brutal lesson. Beginners usually learn it the expensive way. What's interesting, in real panic, the problem is not just being wrong. It's reacting fast when the prices in front of you stop feeling real. So what are you supposed to do in those 5 minutes? You reach for a carton of eggs. The price tag flips from $3.99 to $39.99. Then it drops to 99 cents, then back to $6.50. Other shoppers start grabbing things, shoving carts, checking their phones, sprinting for the register. In that moment, you wouldn't trust the tag. You'd think the store system was breaking. That's the simplest way to understand those 5 ugly minutes in 2010. The numbers on the screen were still numbers. Trades were still going through. But for a brief stretch, the prices stopped acting like useful information. That's the part beginners miss. You assume the screen shows reality. Usually that's fair. But in a real panic, prices can become more like a fire alarm than a fact. They tell you stress is exploding. They don't always tell you value. At 2:47 p.m., that matters. Your phone buzzes. Red candles stretch lower. A familiar stock or ETF suddenly looks insanely cheap or weirdly expensive for a few seconds. Your brain says, do something now. But if the grocery signs were glitching, rushing would be the dumbest move. You'd step back first. You'd wait to see whether the label was real or broken. Same idea here. In a fast market break, discipline is not about predicting the next tick. It's about recognizing when the auction itself is chaotic. An auction is just buyers and sellers shouting prices at each other. When the shouting turns into nonsense, speed feels smart. Usually it's expensive. So the first lesson from the flash crash is surprisingly plain. Sometimes the best read is that the screen is temporarily lying. If that reframe helps, subscribe. 2 of these a week. Which leads to the real question. If prices stop feeling trustworthy, what rule keeps you from making the worst click of the day? Your screen freezes at 2:43 p.m. Then the numbers come back, and they look insane. A stock fund that usually moves like a shopping cart suddenly drops like a dropped phone. Another price vanishes, a third snaps back before you can even blink. In that moment, you don't need a prediction. You need a rule. Start with 3 plain questions on paper, not in your head. First, what would make this market look broken, not normal? Second, if that happens, what action is automatic? Third, what action is forbidden? For a small trader, this can be simple. Say prices gap wildly. Say spreads, the gap between the buying price and the selling price, get weird. You pause. If your stop loss, a preset price where you automatically exit a losing trade already triggered, you accept it. You don't instantly grab a new position, a trade you're currently holding, just to win it back. That last part matters most. Chaos makes you feel like speed is strength. Usually speed is how you turn confusion into damage, so your rule in chaos might sound like this. If quotes look broken, no chasing for 15 minutes, no canceling exits, no revenge trading, jumping into a bigger, sloppier trade right after a loss. Notice what that rule does. It removes the part of the day where your emotions want the microphone. It gives you something solid when the screen stops being solid. But here's where people split apart. Faced with the exact same crash, one person clicks faster. So why do most traders get this exact moment wrong? Same crash, same chart, same red screen at 2:45 in the afternoon. One person starts hammering keys like speed can fix confusion. The other leans back, looks at a card, and does almost nothing. That split is the whole game. On the left, your coffee tips over. Your phone buzzes. Prices jump so fast they stop feeling real. You had a position, a trade you currently hold. It drops hard, then it bounces, then it drops again. Now your brain starts telling stories. Get out now. No, wait, it will snap back. Add more and make it back faster. That isn't analysis. That's survival mode wearing a market costume. On the right, the chart looks just as ugly, but this person already decided what chaos means. If price hits the preset exit, they're out. If quotes look broken, they pause. If they just took a loss, they don't fire again right away. Notice the difference. The panic trader reacts to every new wiggle. The rule trader reacts to a plan made earlier when the room felt calm. And that matters. In a real market break, speed can become a trap. During the flash crash, some stop losses, a preset price where you automatically get out of a losing trade, triggered at absurd levels. Then prices snapped back minutes later. Other people, frozen by shock, did nothing and watched the rebound happen without them. Both felt terrible, but they were different mistakes. The first mistake is forced action. You treat every flashing price like a command. The second is helpless waiting. You hope the market fixes your problem for you. One burns you with bad exits, the other traps you in wishful thinking. The trader with a written card has a third option. Not panic, not hope, a filter, something simple. Is the market functioning normally? Is this my planned exit or a broken print? Am I making a clean decision, or am I just scared? That doesn't guarantee a good outcome, nothing can, but it protects your capital from your worst 5 minutes. The pattern is clear people miss. When prices look broken, the smartest move can feel completely wrong in the moment. Which raises the obvious question, what do you actually do, minute by minute, when the screen goes crazy? Your mouse hovers over the button. It's 2:46 p.m. The chart on your screen just dropped like an elevator with the cables cut. A minute ago, this looked like a normal, ugly day. Now big, well-known companies are printing prices that make no sense. One stock flashes down, disappears, then snaps somewhere else. Your stomach drops with it. So what do? Start with the first rule from the last segment. Before you react, check whether the market is moving fast or whether prices look broken. During the flash crash, for a few minutes, lots of prices looked broken. Liquidity vanished. That means there weren't enough normal buyers and sellers showing real prices. That matters. Your stop loss can behave very differently in chaos. You may expect an exit near one number, but the actual fill, when your buy or sell order really executes, can happen much worse. That gap has a name too: slippage, getting filled at a worse price than you expected. Now put yourself in one small account that day. You're holding a position, a trade you currently hold, entered earlier in the afternoon. Your thesis, your specific reason for the trade, was simple: market weakness, then a bounce from a major level. You even wrote it in a paper journal. Then 2:45 hits, price knifes lower, your stop triggers, you're out, not where you planned, lower, fast. It feels unfair, because it is, not morally unfair, mechanically unfair. The market is no longer offering normal prices. And this is the exact second most people wreck themselves. They don't stop at the first loss. They chase the rebound. They see price snap back and think, I knew it. I was right. Now I need back in, bigger. That is revenge trading, taking a bigger, sloppier trade right after a loss. Notice what changed. Not the chart. You changed. Your goal is no longer to follow a plan. Your goal is to erase pain. The discipline move feels terrible here. You do nothing for a moment. You wait 1 minute, then another. You look for 3 basic signs. Are quotes stabilizing? Are spreads, the gap between the bid price and the ask price, narrowing? Can you still explain your setup in one calm sentence? If the answer is no, you stay out. That doesn't mean you're weak. It means you understand opportunity cost, what you give up by picking one option over another. Yes, you might miss the rebound, but you also avoid entering a market acting like a broken checkout scanner, not a real auction. Here's why it works beginners hate. Missing a dramatic bounce can be a good decision. A good decision is not the same as a good outcome. During those 5 minutes, the safest trader often looked the dumbest. The reckless trader got a lucky screenshot. The disciplined trader kept their account alive. That's the whole game in miniature. In chaos, your job is not to be heroic. Your job is to tell the difference between a real move and a broken price. But that raises a harder problem. In the moment, how do you tell the difference fast enough to act without freezing? Hold on. Would I take this trade right now? That one question can save you when the market starts acting broken. Poker players have a name for walking away from a bad spot. They call it a fold, quitting the hand to protect your chips. In markets, you need the same move. I call it the when to fold test. If this is useful, subscribe. More twice a week. Here are the 3 checks. First, price quality. Are quotes jumping all over the place? Are spreads suddenly huge? Do fills look random? Then treat the price as broken, not meaningful. Second, exit clarity. If you can't say where you're out in one sentence, you don't have a trade, you have stress. A stop loss only helps if the market around it still works. Third, original reason. Ask yourself, is my thesis, your specific reason for the trade, still true? Or am I reacting to the last red candle? If the reason changed, your decision should change too. So the rule is simple. Bad price quality, no clear exit, or a broken thesis. Fold. Not forever, just for now. And once you have that rule, the next question is easy. What does a calm trader actually do in those minutes instead? Next time the market goes weird, do one thing first. Step back. Check your rule card, your written trading plan, before touching the keyboard. That tiny pause can save you. It stops you from turning a broken 5 minutes into an all-day mistake. Want more plain English breakdowns like this? Subscribe. The next one shows how a normal-looking rally, a fast rise in prices, tricks beginners into chasing the worst possible moment.